Can property prices really keep rising considering where they are today? And how much are property prices likely to fall once this cycle eventually comes to an end? There's some of the questions Brett Warren and I are going to discuss in today's podcast. Now, to do this, we're going to look back at history and see what we can learn from the past 50 years of economic and property price changes and what's driven them. And that should help give us some clarity on what's ahead for our property markets and for the value of your and my home. So this is a slightly longer show than normal, but lots of great information, and I know it because I recorded it before I recorded this introduction. So welcome to today's podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's interesting how the narrative in the media has changed. Only a few months ago, it was all about booming property markets, and now the media is full of questions. Questions about how long will this boom last? How far can property values go? Is it all over? Do we have to start worrying? So to discuss what we see ahead, I'm joined by my business partner and National Director of Metropole, Brett Warren. Hi, Brett.
Hi, Michael. Good to be with you. I've certainly noticed some changes at this stage of the cycle as well. The media messages are changing on a week-to-week basis at the moment, and I guess at this stage of the cycle where property price growth is probably slowing a little, the message the media is giving is having changed from that really strong positive message is now it's asking how long will the boom last and what's going to happen to property prices once it's over. So, look, Michael, to be honest, I'm actually interested in getting your thoughts on these questions. Maybe I can start by putting it in context because over the past year, the 22% rate of growth seen across our capital cities this year was the third fastest in history, next to the records achieved in the 80s and the 1950s. I also read your recent blog on Property Update, which explained it wasn't really until the 1950s that real house price growth, that is growth higher than inflation, started to take off. Before the 1950s, the land on the fringes of our capital cities was both close to CBD and relatively cheap, which kept the lid on house prices. But once land closer to the cities became more scarce, along with the high levels of immigration into Australia in the 50s, 60s and 70s, I guess, prices started to rise at a faster rate. Look, according to REA's Prop Track as well, house prices rose a whopping 111% in 1950.
Boy, wouldn't that have been amazing? Even I wasn't around at that time, Brett.
Well, that would have been quite incredible. And that was coinciding with the end of the wartime period, Michael.
Well, they had price controls and rent controls on to protect properties during the war, so I guess it was a catch-up, Brett.
Yeah, and then in the 1980s, the removal of the limits of the interest rates for loans, the floating of the Australian dollar and the introduction of competition from foreign banks really modernised the lending sector.
I remember that well, Brett, because when I first started, you had to put a suit and tie on. You had to go to the banks. There wasn't much choice. The lending restrictions were very different. And then all of a sudden, building societies came in. And so there was a choice. And then there were the securitizers. And Aussie John was the first one who brought that in. Then Mark Burris and others. So that was really a very big change that gave people more money, the ability to borrow more. And they suddenly accepted wives' incomes, two-income households, which wasn't before. That was really one of the things, the easier credit for the typical Aussie family that actually helped facilitate that boom. And I remember the boom of 89 because we had a terrible stock market crash in 87. Fortunately, I didn't have any shares in the market at the time, but I know some of my friends really were decimated. And then there was a boom that led up to the recession we had to have. And in just the 1 year alone, property values then went up 29%. So that was the other time that it was really much higher than this time around.
Yeah, and I guess looking back to those previous periods over strong growth, they've both been followed by price falls. And I guess that's what most people are thinking and the media is talking about. So I'd like to get your thoughts on two questions, Michael. Firstly, can property prices really keep rising? And I know what your answer is going to be, but I'm interested to hear your thoughts on the answer to the following question, which is what's going to happen to property prices in the short term and will they fall after this boom ends?
Okay. Well, I guess the simple answer is yes, property values can keep rising. And yeah, you knew that, but forget the spoiler because it's not everywhere. Not all properties are going to grow in value simultaneously, and definitely not to the same extent as they have over the last year, because in 2020 it was pretty exceptional, other than in the capital city CBDs, the apartments there. Apartments grew, houses grew, regional poor areas, high value areas all grew. But the answer to your second question, Brett, is while property prices are notoriously difficult to forecast, in my mind, it's actually hard to see the same size downturn this time round, well, at least in the short term. So people are wanting to know what's going to happen in the short term. Look, I know you and I have been advising our clients that as we move through this cycle and as the cycle ends, as all property cycles do, it will eventually end. And I believe this will be a shorter one because it actually zoomed into full gear, into sixth gear, into overdrive much quicker. When it ends, we're going to end up with a period of flat growth, no growth, and some property values are going to drop. And I know we've been advising our clients at Metropole, we're going to have a two-tier market. Look, you've often heard me say that property is a game of finance with some houses thrown in the middle. So areas where people's wages are going to grow more, they're going to be the sort of locations where people are going to be still, as the market moves on, be able to afford more. And they're actually going to be prepared to pay more because those areas will be in scarce supply. More people are going to want to live there. But there's going to be many locations around Australia where people, the locals, are just not going to have more money in their pay packet to pay the extra that's required because properties have already increased so much in their local area, and the momentum of the low interest rates and the pent-up demand sort of worked its way through. And I think also moving forward, we've had a lot of first home buyers and they've been brought into the market with first homeowner grants. They've been brought into the market with various incentives. They're going to have difficulty now that they've been taken away, the incentives. They're going to have more difficulty getting deposits. And it's also going to be harder for renters because rents are going to keep rising. But Brett, if you think about it, that's also going to be a problem for first home buyers because if they've got to pay more rent, it's going to be a bit harder for them to save a deposit, isn't it?
Yeah, it certainly is. I think you make a good point there as well with regards to the savings rate. You know, in these types of areas where we're expecting properties not to fall too much, people do have higher rates of savings. They've got higher buffers and, you know, they can generally save more to get into that next property.
Yeah, that's all to do with their income levels. And again, it's not a judge of people, but that's one of the reasons we pay so much attention to demographics. So look, before I go further, I think it'd be really interesting to look back and see what we can learn. If I look back at I guess it's close to 5 decades I've been investing. And if we do that, maybe we can see what's ahead. So Brett, look, we both know that successful investors have got a long-term focus. They think years ahead. They think decades into the future. So in my mind, we need to look back that far, decades, rather than just a year or two or a cycle or so, to get the perspective.
And look, I think that's a really, really good point. One of my favourite quotes of yours is don't make 30-year decisions on the last 30 minutes of news. And, you know, I know that's one of the advantages that Metropole brings to the party when we talk and advise clients. This perspective gained through many, many decades of experience for people like yourself and Ken Race and Kate Forbes, Rita Thomas. There's Belinda Botsolis that's come on board. And even I, who've been investing through a number of property cycles, bring all that information to the party.
Well, I think that is a big difference and one of the reasons that we can help our clients. I used to say it levels the playing fields. No, it doesn't. It actually gives them an unfair advantage. And I think that's going to be even more important moving forward because the rising tide just won't lift all ships. And one of the great things about having been in property for 5 decades is looking back on how our economy and our property markets were many, many years ago. Look, you know the story. I started investing in the early 70s, and it's unfathomable, unthinkable how our economy and how our cities and how our society has changed in the last half a century. I wouldn't have imagined it. I couldn't have imagined it. We didn't have all those high-rise buildings. But maybe we should look back and see what happened with houses. In 1970, with house prices, in 1970, the median house price in Sydney was $18,700, Brett. In Perth, interestingly, Perth was almost as expensive as Sydney. It was $17,500. And Melbourne, it was a poor cousin. The median house price in 1970 was $12,800. Now, I recently read a great article by economist Stephen Koukoulas in Yahoo Finance that I write for every week as well. And I'd like to share a few of the facts from that. And I've got to give him credit for doing a lot of this research. It included also that back in those days, it wasn't 1970, but 71, house prices in Adelaide were 11,900, 18,000 in Canberra, and 11,875 was the median house price in Hobart. Interestingly, the earliest data in Brisbane, I don't know, you were a country town back then, was in 73. And the median house price, the sort of price that we're buying properties for today, was $800,000. Brett, $17,500.
That's amazing, isn't it?
Yeah. Who wouldn't have liked to buy the house their parents bought, Brett, for the price their parents paid?
And the one next door and the next door to that as well.
So that's quite remarkable when you look at that. But, Brett, back then, they seemed expensive. When you first bought your investments, quite a long time ago now, I know, because you were a client of ours, it was expensive, wasn't it?
It was. And we're seeing those headlines now.
Well, it seemed expensive, didn't it?
Yeah, it did. It did at the time, 100%.
So looking back over the last 50 years, Kakula's explained also how unemployment was always a hot topic and political topic, just like it is in the media all the time now. Interestingly, he said that 1965, the unemployment rate, Brett, was 1.3%, a rate today's policymakers could only dream about. Look, indeed, for a period between 64 and 71, and I wasn't following economics then, and that's why it's good to look back and learn these things. Unemployment was about 1.9% or lower for most of the 60s.
Yeah, look, I guess that begs the question, if we, Australia could have an unemployment rate that low back then, what we can do now. But I guess that's a different discussion and a different podcast.
Well, I think if there was an answer to that, Brett, we'd already be there, wouldn't we?
We would. And look, I don't expect you to be able to answer that question, but what does it look back in the past tell us about inflation? Because that's a hot topic at the moment.
Yes, isn't it? Well, Australia's inflation shows some also unthinkable, remarkable results, and I did live through that. In 74 and 75, annual inflation was above 15%. And that's interestingly when I'd started investing. And that's when the Whitlam government, Labor government came in. And that was fantastic. So from 1973 to 83, inflation averaged 11% per annum. Now, I didn't understand about economics. I knew what interest rates were paying, which was over 10%, because that's what happens when inflation's high. But the value of my properties increased. So my first one increased considerably, allowing me to get into my second one. And of course, the mistake I made was I sold those to then buy a family home it was only an apartment when I got married. But the dislocation caused by this huge inflation was in fact following from, because it was excessive, we ended up with recessions, with high unemployment, and actually quite a lot of misery, Brett.
Yeah, I'm sure they were really difficult times. So why hasn't inflation been so low over the last decade, for over a decade or more, Michael? I know the RBA's clearly been trying to increase inflation, knowing that a small amount of inflation is healthy for our economy and low inflation is bad. But what's different now to the past?
Well, I think what you made is a good point, and that's what people are worried about. Too much inflation creates problems down the track, but low inflation isn't good either. It's thought that we need a small amount of inflation, which is when more people are wanting goods and services, using goods and services than they are, so the costs go up a bit. But I think there's a number of reasons for low inflation. And while we have discussed them internally and thought about them, I think I also should give credit to Michael Matusik, who's written a good blog on this very recently, and he gave 5 reasons. And one was that unionised labour is now a fraction of what it used to be. I remember years ago when I was first involved in the workforce and in property, the unions were much stronger. There was large collective negotiation about annual wages, the days of Bob Hawke and the union movement. And so at those stages, wages increases were very high. The unions had more power. I'm not saying this is good or bad. All I'm pointing out is, though, that this is now a thing of the past. And because of that, because there isn't the strong, firm wages growth, inflation is lower. The second point, Brett, is the world is changing. The world's investing heavily in technology, artificial intelligence for the last decade, and this is cheaper. This makes wages lower, inflation cheaper, because technology is taking over from people, so things don't cost as much. Automation, robotics. Look, over the last couple of years, we know it, the algorithm. My phone keeps telling me what to do, what I'm doing, where I should be going. But this lowers inflation because wages aren't going up. But I think the other big thing over the last decade or so is we've had globalisation. Now, boy, is that changing. But lower inflation over the recent decades was influenced by the fact that we weren't producing things in Australia. We were able to get almost anything and everything we wanted from China in particular, more recently from Africa, from other Asian countries. And what that did was lower the cost of goods because we weren't manufacturing in Australia. Of course, we've learned the problems from that. And so the globalization is changing. We're bringing manufacturing and goods back to Australia. And that's great for all sorts of reasons, but that's going to have an inflationary effect. The other reason Michael Matusik suggested that low inflation's been going on for quite a while is immigration. Now, that's a big, big topic, isn't it?
Especially in Australia, yeah.
I mean, people are wondering, is immigration taking away jobs? Is it lowering costs? Look, there's no doubt that people coming in use goods and services. It's good for the economy. Having more people in the economy makes the world go round to help pay taxes and pay for the government. And, hey, it also pays for politicians. I'm not sure that's so good. But what it does do is it actually, the large influx of migrants does limit domestic wages growth when you've got more people in the pool looking for jobs. But interestingly, despite few overseas migrants, up till just recently, we actually haven't really had higher wages, have we?
No, absolutely not. It's been quite remarkable, hasn't it?
Sure. But now that we've reached that 90% vaccination coverage, it looks like our international borders are going to be open and the return of immigration is going to reduce labour competition. And I think that's going to lower wages and salary pressures. And that's one of the reasons that we don't believe the Reserve Bank is going to be able to increase interest rates and cause the drop in property values that people are worried about, because all those naysayers are saying property values are going to crash because the Reserve Bank is going to push up interest rates because that's then going to put people into mortgage stress. Totally different argument. Maybe we could discuss that. But the comment I'm making at the moment is that this is another reason why wages aren't going to go up, because we're going to have a lot more skilled migrants coming in. And the other issue really, I guess, is COVID. Over the last couple of years, we were constrained from spending. We've stashed our cash. We've got bigger war chests than ever. The government has sort of bailed us out and kept us locked down. And in the process, we just haven't been spending. So I think moving forward, inflation probably isn't going to be such a big factor moving forward, and wages growth probably isn't. And on that basis, then I believe, and I know it's contrary to a lot of others, but the people we listen to and Dr. Andrew Wilson, who we work very closely with, similarly believe interest rates should remain low unless we get other outbreaks of COVID, we get other problems occurring. But they are going to rise, no argument about that, but maybe not as till we've got inflation a bit better, because interest rates are currently at the low stimulatory levels to try and get inflation up again. Now, we know the CPI recently rose to 3% over the last 12 months, and overseas it's actually high, 6.2 in America, the highest it's been for a long, long time. But it seems that a lot of these things are temporary rather than something long-term. Of course, we're just going to have to wait and see, but that's my thoughts on it at the moment, Brett.
Yeah, I guess we won't get into it in a lot of detail, but I guess also understanding which are the rising inflation factors and are they artificially inflated at this time as well? Because I know there's a lot of argument around that as well. But look, that's really interesting. Now, there's obviously a lot of fuss about employment and wages at the moment, but I guess looking back in history, what does history tell us about wages?
Well, that's interesting also, because the Australian Bureau of Statistics got lots of figures and facts there. And the average weekly wage and earnings in March 1969, if we're looking back just over 50 years, the average wage, Brett, was $67.20 a week, which meant the average Australian earned $3,495 a year. What that means is when I bought my property in the early 70s and I got $12 a week rent, remember the average wage was $67.20. So it's actually about sort of right that, they were spending about 20% of their salary on renting a place. Unthinkable figures. But interestingly, when you dig back into the data, this was per employed male unit, as they call it. In fact, data on female wages wasn't included way back in the Australian Bureau of Statistics back in 1969. The level of average wages put those house prices, as I mentioned, in better context. So to say that property is expensive today and our kids will never get into it, it always was that way. Now, interestingly, they also were talking about the labour force participation rates. And like most data, if we look back, boy, it was extraordinary. In 66, this, again, I've got to give credit to Stephen Kakoulis' great article in Yahoo Finance. He said the male participation rate was 84%. For married females, it was 29%. And unmarried females, 50%. So overall, 36% of females were in the workforce and 84% of males. Now, look, if you think about it, that's quaint that they'd talk about married females and unmarried. Imagine the fuss that would happen if the politicians and the statisticians talked about that way today.
Yeah, I mean, quite incredible.
So just to put all that in context, the most recent data compared to those figures I mentioned way back 50-odd years ago shows that about 66% of males in the Australian population are working and about 57% of females. And of course, it doesn't say about whether they're married or not. But the answer is that we've got an older population as well. So when they talk about the adult population, no, not everyone's going to be working.
Yeah, definitely some progress there. What other interesting data have you dug up looking back over the last 50 years, Michael?
Well, interestingly, back in 1970, going back to then again, the annual pension was $806 or $15.50 a week. Now, at that stage, not many people had the pension for long. Life expectancy was about 71 compared to about 83 today. Another interesting thing when you dug back was education and how things progressed and what level of education people got. In the late 70s, just 1/3 of students finished year 12, or the equivalent. It was called matric in those days and then became HSC. Today, it's 85%. So only 1/3 finished school. They went to trades and tech and apprenticeships.
Manufacturing.
Yeah. In the 70s, just 3% of young people went to university. And now it's around 40%. We've become a knowledge-based society, Brett, and we are living in the best country in the world. And despite all that's going on, I would argue that it's actually the best time in history as well. And so being that sort of country and segregating in only a small group of capital cities and in the same sort of areas in those capital cities we all want to live in, that's what's making properties expensive at the moment. But it is also interesting just to see, that's 2 generations, how much things have changed. Imagine being able to buy that house in Sydney for $18,700, or for your wages to be $3,500. Imagine being one of the 2/3 of people who didn't even finish year 12, or the 97% of people who didn't go to university. My parents didn't. In fact, my father, I think, only got to the age of 9 or 10, he left school, but he was in Europe at the time. Imagine having 15 years when interest rates were above 10%. I lived through that. Brett, when my home mortgage rate fell below 10%, it fell into the 9s, I was thrilled. And so it is interesting to look back. Now, boy, that was a long-winded discussion about what's going to happen moving forward, but it was interesting in my mind.
Well, it's always good to get a part of history and understand what happened and why those things happen. So thanks for explaining that. Now we've got all that on the table, Michael. Can you tell me what's going to happen in the next 50 years?
Oh, that's really easy. Yeah, sure. Now, actually, look, currently there are about 25.5 million Australians. And earlier this year, the government released its intergenerational report. And that was to help Australia, the government, businesses plan for the next 40 years. So it's not really 50 years, but that's the best we've got. They've got a business plan of what they're going to do. And the intergenerational report projects that Australia's population is going to be 38.8 million, but in 2060, 2061. Now, this is a bit lower than previous forecasts. We know that COVID slowed things down, but Brett, just putting this into perspective, this means Australia's population is going to grow faster than most other developed countries. And despite the reduction in projected population, when you put those into perspective, those trends are monumental. But if you think about it, it's taken Australia over 200 years since European settlement to reach a population of 25.5 million today. But in the next 40 years, our population is going to increase by 13.3 million or so. In other words, we're going to increase by 50
Amazing.
in 40 years.
Yeah.
That is amazing, isn't it? Yeah.
Incredible.
And look, how many people are going to live in each household? There are some suggestions that currently there's 2.5 people in each household, and the suggestion from the intergenerational report suggests there's going to be fewer people in each household. It's going to shrink because we're going to be older. There's more older people. They're going to live alone. There's people not going to get married. Putting all these figures together suggests we're going to need about a third more real estate than we currently have. So to deal with these projected growths between now and 2061, it's likely we're going to require one new property built for every 2 properties that currently exist in Australia. That's amazing.
That's staggering.
All this means is our way of living is going to change considerably. We're going to have more medium density accommodation. We are going to have more high density accommodation. Of course, councils and town planners are going to struggle to cope with this because we've got the NIMBYs, not in my backyard. It's okay to do it over there, but not here. So that's going to make it hard. This is also going to be really important when we make property choices. But in my mind, strategic, knowledgeable investors will be well placed to capitalise on these changes if they know it. And that's why our research team at Metropole spends so much time looking forward and looking at economic changes and demographic changes and what's ahead. Because demography moves slowly. You can see as people change through their stages in life what their requirements are going to be. And that's much more important than looking in the rear vision mirror. But Brett, in my mind, what that's going to mean is a lot more high-rise towers of apartments, not just in the CBDs, but now middle ring suburbs. Now in Brisbane, that's happening in medium rise, not high rise. But if you look at Melbourne and Sydney in particular, there are rings like Parramatta in Sydney and Box Hill in Melbourne and other areas where there's whole towns of high-rise apartments there. And there's going to be a lot more medium density. And we particularly like townhouses in Australia. I believe that's going to be a much more popular way of living with modern large accommodation on compact blocks. You ask what's going to happen in 40 years. Who knows? Who knows what's going to happen to inflation? Who knows what's going to happen to interest rates? But I still think that most people are going to, in general, want to live in our capital cities and, in general, close to the action in the CBDs and the water. I don't know what the average price is going to be in Sydney. It's been suggested it could be $10 million, and the average worker is going to earn $2 million in 50 years' time. I hope I'll be around then, but 50 years, gee, I'm going to be, I'll be about 119, so who knows. But in the meantime, I bet you one thing is still going to be occurring in 50 years' time, Brett. I think the media is still going to be debating whether the Reserve Bank's going to raise interest rates or not.
Yeah, absolutely, no doubt. Look, I think that's really important to understand that bigger picture, Michael. And I know a lot of people now are investing in the latest trend and the latest fad, but most people who are investing in property will probably still have those properties, even if they're retiring in the next 10 or 20 years, if they're looking to pass them on to the next generation for likely 40, 50. So it's incredibly important to understand those big picture trends.
Oh, that's really important, isn't it? You're right, because many people buying properties now are going to retire, as you say, in 20, 30 years, and then they're going to want to live another 30 years on their properties and pass them on. So don't buy something now that's going to be a dud in 5 years or 10 years or definitely in 20 years' time. And that's why we're comfortable, as we said a moment ago, helping our clients invest in modern townhouses that will still have a life to them in many years' time.
Yeah, look, I guess forecasting forward, you put some pretty big numbers there, Michael. Sydney will be worth $10 million, for an average house. What about affordability? How are people going to be able to afford those prices?
Well, as we said, housing's always been unaffordable. It's been hard to get in the market. It was the same 50 years ago when the median house price was around $18,000, as I mentioned. One of my most popular posts on social media this year was actually a newspaper clipping from the Daily Telegraph in 1963, and the ABC initially showed it. And in 1963, the Daily Telegraph had a whole page article when first home buyers complained about the cost of housing and how unaffordable it was then. And what the argument then was, what the journalists then said, was that they needed a smaller deposit and bigger loans. Nothing's changed, Brett.
It's interesting. You could probably run that exact same article today and it'd still be relevant, wouldn't it?
So much so, yes.
Yeah. So how's affordability measured?
Okay, so that's a good point. So what is unaffordability? Look, there's been lots of measurements put, and some of them are not very useful. So one of the ones that we hear bandied around a lot is the ratio of dwelling values to income. That's the most widely one used recently and internationally is compared. So, for example, if in a city, the median dwelling, I don't know, let's make it 500,000 because it's easy to do with some in my head, and the median household earns $100,000, then the ratio would be 5. In other words, dwelling values are 5 times higher than the gross annual income. And there are figures suggesting that if it's more than 6 times, it's actually too expensive. But if you think about it, that way, first homeowners are always going to be disadvantaged using this type of ratio, while wealthier households, they're going to be able to afford properties. So I'm not sure it's a good measure of affordability, but that's what the media tells us, and that's what the naysayers are saying. Hey, it's too unaffordable because the value of the house compared to the income is too high. Of course, the other one is how long it takes to save a 20% deposit. And this usually assumes you can save maybe 15% of your income. And based on that, how long it takes to save a deposit. And that's another method, which I'm not sure is relevant because some people need 20%. There are the various grants. Having said all this, Brett, we had more first home buyers in the market over the last couple of years than ever before because the government has been encouraging them, haven't they?
Yeah, they have. They have.
Now, the other big thing is the proportion of your household income required to service a loan. In other words, if you're using more than a portion of your income to service a loan, and often they say if it's more than 30%, then you're going to be in mortgage stress. I know you often use the expression that people would rather eat Maggi noodles than give up their home. So it actually really isn't a problem how high the percentage is. And the other one is the proportion of household income required to pay rent. That's another measurement of affordability. So on the one hand, it's difficult to get in the property market at the present. And I know I'm going to annoy some people when I say this, but it's not only an issue of affordability. I do understand it's hard to save a deposit. But in many cases, Brett, it seems to be an issue of expectations. Some young millennials expecting to start their property journey in the same type of house it took their parents 30 or 40 years to acquire.
Yeah, you're completely right. I think it's that intergenerational and instant gratification and those kinds of issues as well. So, look, I guess the other clickbait headline we're starting to see now, Michael, is mortgage stress. Interest rates are going to rise, and it's going to cause huge concern for our property markets. I mean, those property businesses out there telling us that the markets are going to crash if interest rates go up by 1% because it'll put all the homeowners and property investors into mortgage stress. And it's often said that if you spend more than 30% of your income on mortgage repayments, that will put you into mortgage stress. I've never really accepted that argument, to be honest. And if you think about it, first-time buyers have to borrow as much as they can to get into the market. And that means they'll have to budget for a while and, like we talked about, delay gratification and maybe eating a few more Maggi noodles at home rather than being in financial stress. But they'll cut back and bring back their discretionary spending to accommodate that.
Sure. So I agree with you. That percentage of 30% of your income, are you talking about a beginner? Are you talking about a first homeowner? Are you talking about an established family with 2 incomes? Are you talking about the wealthier people? It's too broad. Telling us the market's going to crash if 1% interest rates go up, which is what the argument in the media has been for a while. It's the same people saying that, though, Brett, who told us we're going to fall off the fiscal cliff. Remember, they said we're going to fall off the fiscal cliff when unemployment rose to 11%. And then they said we're going to fall off another cliff when JobKeeper disappeared. And then they said there was another, I don't know where all these cliffs come, another one when interest-only loans had to be started repaid as principal and interest. Remember all those scary headlines, Brett?
Yeah, it was one after the other, wasn't it? And as we passed one, they found another one somehow.
And how many of them came through?
Hardly any.
None.
None.
No. So in my mind, the best measurement of mortgage stress is actually home loan arrears or home loan defaults. And currently, in other words, are you paying the bank? Because as you correctly said, you're going to tighten the belt. You're not going to spend as much. You're not going to have as much discretionary income. Now, there's no doubt that always some people are going to get themselves into trouble. Some people have overcommitted themselves and don't have financial discipline. But currently, home loan arrears, in other words, more than 30 days late, is only 1.14% of all home loans. Now, as I said, there's no doubt that some investors have bitten off more than they can chew. Some first home buyers are going to have difficulty. But if those borrowers who got those loans didn't lie when they applied for a mortgage, and we know that there have been some who've bent the truth a bit about their incomes or expenses, but if they didn't, And if the banks did their jobs correctly, they would already have the capacity to pay, well, at least 2.5% more interest payments, because that's the buffer the bank used for a long time. And now they're talking about 3%. And now APRA is actually bringing in even further restrictions. So look, let's look at some of the statistics. CoreLogic says that there are 10.68 million properties in Australia at present. The total property value, residential property market, is close to $9.5 trillion today. Trillion. On the other hand, all the loans against those are just over $2 trillion, meaning that we've got a 23% loan to value ratio over the whole housing market. Now, that sounds pretty safe to me. Now, sure, currently household debt has risen. It's actually currently 23% higher than 5 years ago. And that's what people say, too much household debt. But over the same time, over the last 5 years, household net wealth, net, in other words, what you own minus what you owe, is up 50%. So debt's gone up 23%. Wealth for the average Australian has gone up 50%. That means, of course, some people have done even better. Those who own assets, those who own property, those who own shares, and others haven't done as well. But Brett, I was really interested by a recent report Premium brought out. It showed Australia has become a millionaire factory. The total number of millionaires in Australia rose by 31%, from 485 Australians being millionaires to 635 during the last year alone, the biggest rise in history. And these millionaires control $2.77 trillion of investable assets. So look, just to make it clear, it's said that high net worth individuals in Australia have got their own home plus $1 million of investable assets, discretionary funds. And we know a lot of those clients of ours at Metropole at that level. But I don't think that should put others off, because if others can do it, if others have achieved it, and we've seen it ourselves, Brett, a lot of our clients weren't given the money by their parents. They weren't given a silver spoon in their mouth. They worked hard and got there on their own, didn't they?
They have. They've set about a path. They've got a plan. They've worked with people who have been there and done that. And I think that's really important to understand.
And if they've been able to do it, there's no reason why anyone else who's listening to this can't be there. And if you're already in that high net worth category, that's okay. Keep building your way up the ladder. So we're going to be getting more millionaires according to various studies. Now, again, maybe we should just quickly point out that what we do at Metropole is not only just help millionaires. I mean, I know you and your team deal with beginning investors, home buyers, and also experienced investors. But currently what we're doing is, I guess we're helping them protect themselves from the landmines that are ahead. So we help people fix some of their problems. We help other people improve their situation. We prevent problems in the future.
Yeah, I think at this stage of the cycle as well, Michael, most people can probably buy anywhere 12 months ago and they've done well on their property and they don't really understand it. They think it's going to keep working. And I know you often say you don't want to get it right the first time. It's probably the worst thing you can do. But I think what we do is really importantly lower the risks and really help people understand, that we're investing for the longer term and looking to make sure these fundamentals stack up. I'd much prefer to have an average conversation with them now than a really, really good conversation with them in 20 years' time than the other way around.
Sure. Well, I think the other thing that you pointed out a moment ago is that we always start by having a plan for them, because a lot of investors have gotten into the market without a plan. They actually don't realize that it's a long-term process. Researching isn't the same as searching. You've got to do your homework. But I know a lot of people come to you and our team and basically say, well, how much are your fees? Or where should I invest? And that's really superficial conversations. In my mind, really what we've got to talk about is, where are you now? Where do you want to get to? What is your risk profile? What is your resources? What's your cash flow capacity? And then build them a plan that's realistic and shows them what they can do or what they should do if they want to achieve their goals.
Yeah. Look, getting back to the future, I know another clickbait headline is the apparent debt bomb that's waiting to blow up. Any concerns on that?
No, I'm not. Look, let me give you some reasons I'm confident about this extra debt that people have got. First of all, we've got a stable banking system, and that's in part because we've only got 4 banks lending the majority of funds for residential real estate, and they're tightly controlled by our regulators. Our banks, as we said a moment ago, require people to have a large deposit. And if they can't provide the loan, they can get lender's mortgage insurance. If they can't provide a deposit, they get lender's mortgage insurance. But that actually protects the banks. It protects the lenders, not the borrowers. So it's really important to have a stable banking system, because what created the global financial crisis back in 2008 was the poor loans, the dummy loans that were done in America, and a banking system that wasn't secure. So the regulators have learned from that. In fact, if anything, they've looked too firmly at it at the moment. And anyone who's attempting to get a loan recently knows that. They're looking maybe not too carefully, but they're looking very, very carefully at your income and expenses. In fact, they tend to shade your income, particularly if it's property rental. In other words, they only accept 75, 80% of your income, not 100% of serviceability. At the same time, they exaggerate your expenses, and then they stress test your ability to repay the loan, even if interest rates rise 3% now. So the Reserve Bank, when they do raise interest rates, and they will probably only increase them about 1% to bring them back from stimulatory to neutral. So it's really unlikely that the banking system is going to implode from the debt bomb that people have been talking about, that you mentioned. I think the other thing is, moving forward, people have got jobs. We've got income security. Yeah, the economy had a bad quarter in the September quarter, but in general it was better than most economists expected. And now jobs are being created, borders are remaining open, international borders are opening up. And so therefore people, when they have job security and slightly higher wages, all this means is they're going to be able to repay their debts. They're not going to get into mortgage stress. And unless we had huge unemployment, it rose so much that people couldn't repay their debts and had to give away their homes and default their mortgages, that's not likely to happen. So that's another reason I'm not concerned about the debt bomb, like you asked. And the other one is, we've stashed our cash. Most households in Australia are better off financially than before the pandemic. Australia's wealth skyrocketed over the last couple of years, despite enduring that once in a 100-year pandemic, despite the first recession in 3 decades. Household wealth rose considerably. The average net per capita worth increased 20% over the last year alone, and households are doing well. Look, we've got to be fair. Not everyone's benefited. The rising tide didn't lift all ships, and we can't belittle those small businesses that had to close down, no fault of their own, or those who lost their job. But I guess we're all in the same ocean, but not in the same boat. But older households, wealthier households, have seen their wealth surge, while many young households, I guess they did miss out in some ways. So those who owned assets, the rising house prices, that was a big factor. The rising super funds and their rising share portfolio. So when we talk about net wealth, though, when we talk about household wealth, it actually is net wealth. Again, debt has gone up, but if your assets are more than your debt, there's not that much to worry about. So basically, long-winded answer again, am I worried about a debt bomb or problems with our banking system or huge defaults? No, Brett, no, I'm not.
Okay, Michael. So what's likely to happen to property prices in 2022? I know a lot of commentators are putting things out there at the moment. What are your thoughts?
Well, I see 2022 as still being a good year, and there's lots of reasons to think that. Look, I believe house price growth peaked probably in March 2021. In other words, the highest rate of growth was then, but it slowed down throughout the year. But having said that, they're still growing. And next year, look, it depends who you speak to. All the economists from the big banks are suggesting somewhere between 6 and 8% growth in 2022. And I'd agree with that. Now, I'm not saying it because they said it, because in fact, they got all their predictions wrong last time. And if the economy does pick up, and as the Reserve Bank hopes, and if we do get 200,000 migrants coming to Australia in 2022, and that's a big if there are no more COVID variants, our property markets should perform even better, because if the economy picks up and if wages growth isn't rising because we've got all these migrants, then the Reserve Bank's not going to put up interest rates. So at the same time, rental returns, boy, they're doing really well. So we've got a shortage of properties other than the CBD. So I see substantial capital growth, not as good as last year, and rental growth. So overall, investors' returns will be there. Home buyers are still moving into upgrading their lifestyles. Millennials are moving out of apartments into homes. And investors are only now getting into the market, as they tend to at the end stage. They wait to hear for a year, Brett. Every weekend auction clearance rates are high. Every week auction house price values have gone up. The problem, though, is that those investors who get in at the end of the cycle, and it's not end as like it's going to finish straight away, but in the last stages of it, they often make mistakes. They don't recognise how we're going to have this two-tier property market, and they often get into the lower price bracket properties or regional properties, and they're unfortunately going to be the casualties of the next downturn, because there always is one. How much the prices are going to fall in 23, 24 will really depend upon how strictly APRA gets involved and how high interest rates go, Brett.
Yeah, I think, like you alluded to, Michael, the X factor there is definitely going to be the open borders and the migrants and the students coming back and seeing how that's going to work with things with APRA and the RBA. So that's fantastic. I really appreciate your thoughts, Michael. It's going to be certainly an interesting 2022 and beyond.
Yes, it will. So if people who've taken the time to listen to this much longer show than normal, Brett, want to take advantage of the opportunities and not fall into the landmines, I think you should take a minute or two to look at what our team at Metropole does. Go to metropole.com.au. And one of the things you'll find we don't do is we don't sell property. And therefore we have no vested interest. In fact, I know, Brett, one of the first things you and your team do is actually give them strategic advice, which means that you can actually say, hey, I don't think you're ready to buy, or I think you've got to sell first. Well, when they go to most people, because they make their money out of either selling properties or buying properties, they actually make them transact. And that's not what we always do.
Yeah, absolutely, Michael. I agree. I think being January, it's the perfect time to reset the goalposts for the year ahead. And rather than just rushing into and doing something, actually taking a step sideways and putting things down on paper, putting a plan, working out where you'd like to get to, and then actually working backwards, reverse engineering. And that's exactly what we help our clients do throughout the process.
So really, you've got to be part of a team putting this together. You can't do it on your own. It's a process. And interestingly, the property we eventually buy is the physical manifestation of a whole lot of discussions and decisions that have gone on before, including which ownership structure, what sort of finance. And finance isn't just related to interest rates, location, what blend of capital growth and cash flow you require. So that's all that goes into a plan. And then, and only then, should you be looking at a property. But most people do it the other way around. They choose a suburb and then find a property and then try and make it fit into what they want.
They do. And you can always find information and data to reflect that on Google, can't you?
Oh, definitely. You can always find something to support your preconceived ideas, which I guess is called confirmation bias. So if you want our team, Brett and my team, on your side, go to metropole.com.au, find out about what we do, leave your details, and why not have a chat and see how our holistic service can help you. We have strategic property advice, financial planning, wealth advisory, renovations, development, property management, financial planning, and business advisory with our business partner, Mark Creedon. Metropole.com.au. It's going to be a fun year ahead for property, Brett. I look forward to having these regular chats with you.
Really looking forward to it. Thanks, Michael.
Well, I hope you got some benefit from my chat with Brett today. And if you did, I'd like you to help me in my quest to make as many people as financially literate as possible and help people take advantage of our property markets that are going to be very different in this new year. Please tell just one person about the Michael Yardney podcast. Of course, I'd be thrilled if you told the world by leaving a review. There's a share up in the podcast app, or just tell somebody about what you got out of today's show. Now, I think there was so much information covered. May I recommend you actually go back to it and listen to it again, but maybe do it at 1.5 or 2 times speed and just get some of those nuggets that took me quite some time to dig back into the history over the last 50 years. Now, over January, we're having 3 shows a week rather than the normal 2, but I'll be back soon. But you can catch me in between on social media. Just look for Michael Yardney, or you can go to our private Facebook group. Look for the Property Update private Facebook group, where every day I leave some tips and some information I don't leave elsewhere. As I said, I'll be back a bit more frequently over the rest of this month, but in the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?